In this video, we're going to learn about discount revenue and discount expense. What is a discount? Discount means a deduction or a reduction from an original amount. For example, we have an amount payable of $1,100. The discount of 10% will be applied. To calculate the discount amount, we take 10% multiplied by $1,100, and this gives us a discount amount of $110. The amount actually paid would be $1,100 less the discount amount of $110. Therefore, the amount actually paid is only $990. As you can see here, the amount paid is lesser than the original amount. In this course, we only learn about discount received from accounts payable or discount given to accounts receivable for early payments. Discounts are determined based on the credit terms. Credit terms are terms of the credit arrangement offered to the accounts receivable or offered by the accounts payable. The credit terms tell us if a discount applies for early payment and when full payment must be made. Here's an example of how credit terms might look like. This basically means that 5% discount is given or received if payment is made within 10 days of purchase or sale. Even if early payment is not made, full payment of the amount owing must still be made within 30 days of purchase or sale. Firstly, let us have a look at discount revenue, which is basically discount received from an accounts payable. In the examples that follow, we must note that our business is Choco Treats. Here's the first transaction. This is a purchase invoice, and we can see here that Choco Treats has purchased inventory from Cocoa Supplies on credit totaling $1,200 plus GST $120. Therefore, Choco Treats now owe Cocoa Supplies $1,320. In this next transaction, we can see here from the credit note that Choco Treats returned inventory to Cocoa Supplies totaling $100 plus GST $10. This reduces the amount owing to Cocoa Supplies by $110. Here's the third transaction. On the 8th of May, a payment is made to Cocoa Supplies for the balance owing. So firstly, we'll need to calculate the balance owing before any discount is applied. On the 3rd of May, when the credit purchase was made from the accounts payable, the amount owing was $1,320. On the 6th of May, when there was a purchase returned to the accounts payable, this reduced the amount owing by $110. Therefore, on the 8th of May, the balance owing to the accounts payable is $1,210. To work out if discount applies, we'll need to have a look at the credit terms offered by the accounts payable. We'll also need to pay attention to the dates of the transactions. Looking at the credit terms, we can see that 10% discount will apply if payment is made within 10 days of purchase. Looking at our transactions here, we can see that the purchase was made on the 3rd of May, and the payment is made on the 8th of May. From the date of purchase to the date of payment, that's only 5 days. And that's definitely within 10 days of purchase. In this case, we will definitely receive the 10% discount from the accounts payable. Lastly, let us calculate the amount paid to the accounts payable after discount is applied. As we can see here on the 8th of May, the balance owing to the accounts payable was $1,210. The discount revenue, or the discount received from the accounts payable, is calculated by taking 10% multiplied by the balance owing of $1,210, and that gives us a discount revenue amount of $121. The amount paid to the accounts payable is calculated by taking the balance owing of $1,210 less the discount revenue of $121. Leaving us with $1,089, which is the amount that was physically paid out of the bank account of Choco Treats to the accounts payable cocoa supplies. There are different ways of payment can be made. Payments can be made electronically, such as online transfers, or in this example here, we can also use checks to make a payment. The check part is the part that is retained by the business making the payment. In this example here, Choco Treats will keep this part as record of the payment made to Cocoa Supplies. Let's have a look at how the check part might look like for this payment that was made to Cocoa Supplies. The payment was made on the 8th of May to Cocoa Supplies, and it was for invoice 33, credit note 22, which reduced the amount owing, and we also note that 10% discount has been applied. The amount actually paid to Cocoa Supplies was $1,089. After payment is made to Cocoa Supplies might also issue a cash receipt to Choco Treats to confirm that payment has been made for the balance owing. Here we can see in the cash receipt that payment has been made for the balance less discount totaling to $1,089. Now let's identify the effects on the accounting equation for the following transaction. Payment to accounts payable for the balance owing $1,210 less 10% discount $121. Now because we know that this is a cash transaction where a payment has been made out of the bank, we know that firstly, the bank account has been affected. Now bank would typically be classified as an asset. In this case here, the bank has decreased by the amount of $1,089, which is representing the physical amount that was actually paid to the accounts payable after the discount. It is basically calculated by taking $1,210 minus $121. After we have identified the effects on the bank, we ask ourselves, what was this payment for? In this transaction, a payment is made to the accounts payable for the balance owing $1,210. Accounts payable is classified as a current liability. So under liabilities, the accounts payable has decreased by $1,210. Now remember, $1,210 was the full amount owing to the accounts payable. Therefore, after making this payment to the accounts payable, we no longer owe the accounts payable this liability of $1,210. That is why the accounts payable is decreasing by the full amount, $1,210. The last effect that we'll need to identify would be the 10% discount of $121. Because this is a discount that we have received from the accounts receivable, it is therefore a discount revenue. Under the owner's equity, when discount revenue increases by $121, this therefore increases the profit by the same amount, which therefore leads to an increase in owner's equity of $121. Now let us check and see to confirm that our accounting equation remains balanced. So here we have our accounting equation, assets equals to liabilities plus owner's equity. We can see on the left side, we have our assets decreasing by $1,089. Whereas on the right side of the equation, we have our liabilities decreasing by $1,210, whereas our owner's equity increased by $121. Here we can confirm that our accounting equation definitely remains balanced because on the left side of our equation we have a decrease by $1,089, and on the right side of our equation we also have a net decrease by $1,089. In this next section, we'll be looking at the accounts receivable discount, which is discount expense. For the transactions that follow, note that our business is still Choco Treats, and where it applies, note that a markup of 50% is applied to all inventory. Here's a copy of the sales invoice. we can see here that Choco Treats, our business, has made a sale to Sweet Shop, our customer. And the sale has been made on credit totaling $1,260 plus GST $126. We know that this transaction is a credit sale because firstly, in this document, we can see that this is a sales invoice. And secondly, we can see that the credit terms are included for this credit transaction. When we're describing a sales transaction, we will also need to include the information about the cost price of the inventory sold, which in this case here is $840. For your reference, this is how we calculate the cost of sales by taking the selling price of $1,260 without GST divided by 1.5, because here we are told that a markup of 50% is applied to all inventory sold. Next, here we have a credit note. We can see here that the business Choco Treats has received sales returns from the customer Sweet Shop totaling $60 plus GST $6. We know that this is a sales returns because firstly, the source document is a credit note, which means some sort of return has occurred. Because this return relates to a customer, in this case here, Sweet Shop, we therefore know that this has to be a sales return. When describing a sales return transaction, similarly, we will need to provide information about the cost price of inventory returned, which in this case here is $40. To calculate the cost price, we take the selling price of $60 excluding GST divided by 1.5 because the markup that was applied was 50%. Here's the third transaction. On the 10th of June, Choco Treats has received a payment from Sweet Shop for the balance owed. Firstly, we'll need to calculate the balance owed by the accounts receivable before any discount is applied. On the 5th of June, a credit sale was made to the accounts receivable for the total amount of $1,386. On the 8th of June, there was a sales return from the accounts receivable totaling to $66. This reduces the amount owed by the accounts receivable by $66. Therefore, on the 10th of June, the net amount or the balance owed by the accounts receivable was $1,320. Next, we need to check the credit terms that were offered to the accounts receivable. In this case here, we can see that a 5% discount will be given to the accounts receivable if payment is received from the accounts receivable within 7 days of sale. As the sale was made on the 5th of June and the payment was made on the 10th of June, there were only 5 days from the day of sale to the day of payment. Therefore, the accounts receivable is definitely entitled to the 5% discount. Now let us calculate the amount received from the accounts receivable after discount has been applied. On the 10th of June, the balance owed by the accounts receivable was $1,320. The discount expense, which is the discount given to the accounts receivable, is calculated by taking 5% multiplied by the balance owed of $1,320. This gives us a discount expense of $66, which reduces the amount that the accounts receivable has to pay the business. Therefore, the amount that is actually and physically received from the accounts receivable is only $1,254. And this amount of $1,254 is physically received in the bank account of Choco Treats. Once Choco Treats has received payment from the accounts receivable Sweet Shop for the balance owed less discount, Choco Treats will issue a cash receipt to Sweet Shop to confirm that payment has been received. Here we can see in the description of the transaction, Choco Treats has received payment from Sweet Shop for balance owed totaling $1,320 less 5% discount of $66 because payment has been received within 7 days of sale. Now let's identify the effects on the accounting equation of this transaction. The receipt from accounts receivable for the balance owed $1,320 less 5% discount of $66. Because we know that this is a cash transaction where we have received cash from the accounts receivable, we know that our first effect would be on the bank, which is an asset. In this case here, the bank has increased by $1,254, which represents the physical cash that has been received from the accounts receivable sweet shop. The next thing we ask ourselves is, what did we receive the cash for? In this case here, the cash was received because of a payment received from the accounts receivable for the balance owed $1,320. Now, accounts receivable is a current asset. So we go to assets, and here we write accounts receivable. And because we know that this transaction here relates to the accounts receivable paying up a balance that was owed, we therefore know that the balance of the accounts receivable is going down by $1,320. And that was the full balance that was owed by the accounts receivable. In other words, after this transaction, the accounts receivable no longer owes our business $1,320. Lastly, we will need to recognize the 5% discount of $66 that has been given to the accounts receivable. And discount given would therefore be a discount expense for our business, Choco Treats. So under owner's equity, we recognize discount expense that has increased by $66. And when an expense increases, profits decrease by $66, and therefore this leads to owner's equity decreasing by $66. Now let us check and see to confirm that our accounting equation remains balanced. So here we have our accounting equation, assets equals to liabilities plus owner's equity. We can see here that our assets have increased by $1,054, but it also decreased by $1,320. So in other words, there was a net decrease of $66. There were no effects on the liabilities. However, there was a decrease in the owner's equity by $66. So looking at this here, we can confirm that our accounting equation remains balanced because our assets show a net decrease of $66 on the left side of our equation, whereas on the right side of our equation, we have also a decrease of $66, which is in the owner's equity. In summary, when payment is made to the accounts payable within the discount period, the discount is received, and this is called a discount revenue. This is calculated by applying the discount percentage by the balance owing to the accounts payable at the time of payment. On the other hand, when a payment is received from the accounts receivable within the discount period, a discount is given. This is called discount expense, and this is calculated by applying the discount percentage by the balance owed by the accounts receivable at the time the payment is received.